Net income of $11.6 million, delivering 1.48 cents per diluted share for Q2 2026.
That is a solid bump from Q1, especially when you're looking at their massive $3.6 billion total asset base.
Right, so no throat clearing today. We are jumping straight into the numbers for Home Bancorp, ticker symbol HBCP.
Yeah, the parent company of Home Bank.
Mhm.
And, we are pulling this data directly from their Q2 earnings press release, plus the latest investor presentation.
Exactly. And the mission for this deep dive is really to give you, the listener, a total shortcut to understanding the financial health and really the growth trajectory of a highly resilient regional bank.
Because by unpacking HBCP, you actually get this incredibly unique window into the real economic engines of southern Louisiana and increasingly over in Houston, Texas.
I always like to say regional banks basically operate as the vascular system of the local economy.
Oh, that's a great way to put it.
Right. I mean, the numbers in this report, they basically tell us how healthy the blood flow of capital is in the Gulf South region. Are businesses expanding? Are they getting the cash they need?
Yeah, you can listen to economic projections all day long, but, loan and deposit data tells you exactly what operators are actually doing with their money in real time.
So to understand the health of this local economy, we first have to look at the bank's bottom line, right? Are they actually growing?
Well, looking at the top line, both sides of Home Bancorp's balance sheet are expanding simultaneously, which is key.
Right.
Loans grew to $2.8 billion, which is a 7% annualized increase just for the second quarter.
And then on the other side of the ledger, deposits reached $3.1 billion, which is a 6% annualized increase.
Yeah, and that simultaneous growth is a really critical baseline. I mean, a bank can aggressively grow loans by, dropping its underwriting standards.
Which you never want to see.
Yeah, exactly. Or it can swell with deposits if local businesses are just hoarding cash and refusing to invest it.
So seeing both move up in tandem like that suggests a really balanced regional expansion.
It does. But, the metric that bridges those two numbers is what really stands out to me. Their loan-to-deposit ratio hit 91% this quarter.
Which was exactly their stated target.
Yeah. Hitting that specific 91% target is this huge indicator of severe operational efficiency.
How so? Break that down for someone who might not track bank ratios every day.
Well, a bank's core mandate is essentially capital intermediation, right?
Yeah.
Taking in localized deposits, like the cash you park in your savings account, and efficiently pricing them as credit out in the community.
Right, lending it out to businesses?
Exactly. If a bank operates at, say, a 60% ratio, they are essentially just warehousing cash.
Just sitting on it.
Yeah, they're sitting on liquidity, probably parking it in low-yielding securities, and really failing to finance regional growth.
They become a vault rather than an engine.
That's perfectly said.
Yeah.
But on the flip side, pushing it too far the other way introduces immediate fragility.
Because if you creep up toward 100% or push past it, you are basically lending out more than you're taking in natively.
Right, which forces the bank to rely on really expensive, volatile, wholesale borrowing just to fund their loan book.
And that is exactly how you create those severe liquidity traps when credit markets seize up, right?
Absolutely, which makes 91% this, optimal operating tension. They are maximizing the yield on the capital they capture by putting the vast majority of it to work as productive loans.
While still strictly maintaining that 9% structural cushion to absorb, any sudden deposit flight.
Yeah, or localized liquidity shocks. It requires just an incredibly tight calibration between the loan origination teams and the deposit gathering side of the business.
And that calibration gets even more fascinating, I think, when you layer in their corporate history.
Oh, for sure.
Because they were originally founded back in 1908, meaning they opened their doors in the immediate aftermath of the Panic of 1907.
Right.
But, and this is the crazy part to me, they didn't actually complete their initial public offering until October 2008.
Which is just wild timing.
Right. October 2008 was the absolute epicenter of the global financial crisis. Lehman Brothers was gone. Equity markets were totally imploding. How does a bank with that kind of timeline manage this steady growth today?
Well, a bank does not launch a successful IPO in the darkest weeks of the Great Recession without a highly scrutinized, deeply conservative underwriting culture.
Institutional memory matters in banking, doesn't it?
It really does. When an organization's major structural milestones are forged during existential macroeconomic crises, you tend to see this ingrained aversion to speculative risk.
That historical DNA is definitely influencing how they manage the spread on their $3.6 billion asset base today.
Absolutely.
So if they are deploying 91% of their deposits into loans, the next logical question is, how much profit are they making on that spread?
Well, let's look at the mechanics, because loan volume only really matters if the margin itself is profitable,
Right. And their net interest margin, or NM, expanded by 8 basis points to 4.24% in Q2.
which is super impressive. Generating a 4.24% IM in today's complex interest rate environment requires a very specific structural advantage on the balance sheet.
Right. It requires managing both the asset yield and the liability cost concurrently.
Yeah. The data shows they pushed the average yield on their loans up to 6.46%.
But crucially, the cost of their interest-bearing deposits dropped slightly, down to 2.28%.
They are widening the gap from both directions.
I like to frame this using a retail analogy, right? It's like they buy inventory at wholesale and sell it at retail.
I love that.
And this quarter, their wholesale costs literally dropped a penny while they were somehow able to raise their retail prices.
Exactly. And a lot of regional competitors are currently trapped in the inverse scenario right now.
Where their loan yields are static, but their deposit costs are just accelerating because customers are demanding higher rates.
Right. We are seeing that duration mismatch cripple institutions across the sector.
I mean, a bank that loaded up its balance sheet with 10-year fixed-rate commercial loans a few years ago is basically suffocating today.
Oh, yeah. They are earning a fixed 4% on the asset, but suddenly having to pay 4.5% just to keep the deposits in the building.
So how does Home Bancorp sidestep that duration trap?
They do it through the structural composition of their loan book. Basically, 28% of their total loans are floating rate instruments.
Meaning they reprice every 3 months or less, right?
Exactly.
Wow, that is massive structural agility. Over a quarter of their entire loan portfolio automatically adjusts to the prevailing interest rate environment on a quarterly basis.
It essentially transfers the interest rate risk from the bank's balance sheet right back to the borrower.
So when benchmark rates move, the yield on that 28% bucket moves in lockstep.
Yeah, this allows the bank to aggressively defend its net interest margin. Instead of waiting, years for legacy loans to mature before they can originate at a higher market rates.
Their existing portfolio generates higher interest income almost immediately.
Exactly.
Now, that agility explains the 4.24% margin, but it also raises a pretty big question about the borrowers themselves, doesn't it?
It does, yeah.
Because shifting the interest rate risk to the borrower means the local business owner has to absorb that higher debt service.
Right. To sustain that without triggering defaults, the bank has to be lending in geographies and sectors that generate enough robust cash flow to handle those fluctuating quarterly payments.
Right. So we know they're making a great margin on their loans, but to understand their true risk, we need to know exactly who they are lending to and where.
Let's unpack the map. Geographically, the portfolio relies on their traditional Louisiana footprint for stability.
Right. With the Acadiana region comprising 28% of the loan market and New Orleans matching that at another 28%.
But the major pivot in their deployment strategy right now is this aggressive expansion into Texas.
Yeah, Houston now makes up 21% of their overall market diversification.
And Houston is definitely the growth engine to watch here. The report notes a 9% annualized loan growth rate year-to-date just in the Houston market.
Which dramatically outpaces the overall bank's 3% annualized growth year-to-date.
Right. They are using the stable deposit base of those legacy Louisiana markets to fuel commercial lending in one of the densest industrial and corporate hubs in the country.
Because Houston provides the raw scale required to deploy commercial capital at that kind of velocity.
Yeah, it gives them access to a much larger ecosystem of middle market companies, logistics operators, energy transition firms, stuff they couldn't access purely within their historical footprint.
It's essentially a strategic geographic hedge against any localized slowdown in southern Louisiana.
Exactly.
Okay, wait. If we are analyzing what they're funding with this expansion, we have to address the glaring metric in the loan composition.
I know you're to say.
Right. A combined 44% of their total loans are concentrated in commercial real estate.
Yeah, it's a big number.
Every financial headline right now points to CRE as a ticking time bomb. I mean, we are seeing constant doom and gloom coverage of empty office towers, distressed syndicators, plunging valuations.
Oh, absolutely.
So isn't having 44% of your loans in CRE a massive red flag for the listener to worry about? Like, how does a regional bank justify sitting on a 44% CRE concentration?
Look, the headline fear around CRE is totally valid right now. But the asset class is not a monolith, right? Analyzing the underlying collateral changes the risk profile entirely.
Okay, calm the waters for us. What's the distinction here?
The critical distinction within Home Bancorp's portfolio is the division between owner-occupied and non-owner-occupied properties.
Got it.
So of that 44% total we just talked about, 28% is owner-occupied CRE.
Leaving only 16% as non-owner occupied.
Exactly. So the functional difference on the ground really comes down to the source of the mortgage payment.
Because non-owner occupied is the speculative side of the market driving all those distressed headlines.
Right. It's precisely the kind of developer-driven projects that rely on external leasing. Like a developer builds a suburban office park or an outdoor retail center and assumes all the risk of finding third-party tenants to sign long-term leases.
And if macroeconomic conditions shift or corporate footprints shrink like we're seeing now,
The building just sits vacant. There's no operational revenue being generated inside the walls to service the debt, which leads to an inevitable default.
but the 28% sitting in owner-occupied CRE operates on a completely different mechanical reality, doesn't it?
It does. These are loans underwritten to operating companies
Yeah.
that just happen to be buying their own physical location.
Right, like a medical group purchasing their clinic or maybe a regional logistics company financing their own distribution warehouse.
Exactly. The cash flow servicing those loans comes directly from the daily operational revenues of an established business, not from the speculative hunt for a tenant.
So it is fundamentally a commercial and industrial loan that just happens to be heavily collateralized by the real estate it occupies.
Right. And the business owner has a vested, basically existential interest in maintaining the property because it literally houses their livelihood.
That makes total sense. So because 28% of their total loans are to business owners who actually operate out of the buildings they're financing, that heavily weighted owner-occupied structure makes the 44% headline figure drastically more resilient.
Yeah, much more stable than a developer relying on unpredictable tenant leases.
But, speaking of red flags, no bank is perfect. A resilient portfolio structure still has to withstand the reality of economic friction.
Oh, for sure. No underwriting model is flawless, and operating businesses do fail.
Right. So what happens when loans actually do go sour, and is management ignoring the problem?
Well, the true measure of a bank's management isn't whether they experience defaults, it's how aggressively they provision for them before the capital is unrecoverable.
And the data on their problem loans points to a highly defensive posture.
It does. Non-performing assets, which are loans that have ceased generating interest or properties taken into foreclosure, actually decreased this quarter.
Down to $39.2 million.
Right, which represents just 1.09% of their total assets.
Wow. Seeing non-performing assets contract in a high interest rate environment signals really stringent initial underwriting.
And aggressive asset management, yeah.
But what stands out to me is the action they took despite that decrease. Because even with non-performing assets shrinking, the bank still proactively added a $762,000 provision to their allowance for loan losses in Q2.
Yeah, they ran right through the income statement. The allowance for loan losses is really the ultimate indicator of a bank's forward-looking risk assessment.
And it currently sits at $34.0 million.
To contextualize the depth of that reserve, that $34 million represents 128% of their non-performing loans.
Think of it like a casino analyzing the risk on its floor, right?
Okay, I like this.
They don't just hold enough cash in the vault to cover the chips currently being cashed out at the cage. They run probability models on every table and hold a massive surplus of reserves based on the expected value of future payouts.
That's a perfect analogy. Home Bancorp is holding 128% coverage, meaning they could theoretically write down every single non-performing loan on the balance sheet to zero tomorrow and still retain millions of dollars in excess reserves to absorb future shocks.
That fortress-like approach to reserves is exactly what you want to see as an investor or a depositor.
It really highlights the difference between incurred loss models and expected loss models. They aren't waiting for a specific commercial borrower to officially default before scrambling to find the capital to cover the write-off.
They're provisioning capital in advance out of current earnings based on expected losses and changing economic activity.
Exactly.
And Darren E. Guidry, the newly announced president of the bank, addressed this directly in the earnings release. I have the quote right here. He stated, "We continue to proactively identify and resolve problem loans as quickly as possible. While criticized loans increased during the quarter, we do not anticipate any sizable losses."
And that focus on criticized loans is really telling.
Explain what a criticized loan is, just for clarity.
So, criticized loans are loans that are still performing, the borrower is still making payments, but they're showing early signs of potential stress.
Ah, got it.
So mentioning them proves they are monitoring the portfolio on a really granular month-to-month basis. They are forcing borrowers to the table to restructure or resolve issues at the first sign of cash flow degradation.
Rather than letting the assets slide all the way into the non-performing category.
Right. Taking that $762,000 hit to earnings today mathematically protects the balance sheet for the next few years.
Okay, so we've established the bank is profitable, growing in Texas, and incredibly well reserved against risk. So what is the ultimate payoff for the people who actually own the company?
Well, management is definitely focused on total shareholder return. They are utilizing multiple levers to return capital while preserving that regulatory fortress we just talked about.
Starting with direct yield, right? The board declared a 3% increase in the quarterly cash dividend.
Bringing it to $11.32 per share, which is payable in August 2026.
And, board-approved dividend hikes in a complex macro environment are pretty clear signals of sustained earnings visibility.
Oh, definitely. But the metric that really dictates long-term shareholder wealth creation in the regional banking sector is the tangible book value per share, or TBV.
Right. And Home Bancorp's TBV now sits at $47.02.
And the trajectory of that metric completely validates their capital allocation strategy. Since 2019, they have driven an 8.8% compound annual growth rate in tangible book value per share.
Compounding the liquid, intrinsic value of the bank at nearly 9% annually over a 7-year period that included massive market volatility.
That is a significant achievement.
And a major catalyst for that per-share compounding is their deliberate reduction of the share count, isn't it?
Yeah, they actively repurchase shares. They brought back 17% of their outstanding shares since 2019.
Which artificially increases the ownership stake of every remaining shareholder without requiring them to buy another dime of stock.
Exactly. They aren't just hoarding their $453.5 million in shareholders' equity. By buying back shares when the market undervalues the underlying asset portfolio, they generate instant accretion to that tangible book value.
And they still have 383,170 shares eligible for repurchase under the current plan.
They do, yeah.
But wait, deploying capital for dividends and buybacks inherently reduces the raw equity on the balance sheet, right?
It does.
They are actively draining their shareholders' equity to reward investors. So the structural tension is, are they returning too much capital at the expense of safety?
That's a fair question. But the regulatory ratios indicate they are balancing the distribution perfectly.
Okay, how so?
Even after the aggressive repurchase program and the dividend hikes, their Tier 1 capital ratio remains extremely robust at 12.11%.
Wow, okay.
Yeah, they operate well above the thresholds required to be classified as well capitalized. So that gives them the dry powder to absorb credit shocks, pursue further Houston expansion, and continue the buyback program simultaneously.
Incredible. So pulling all of these data points together really gives us a comprehensive read on this economic vascular system.
It really does.
We looked at HBCP's strong Q2 data, which reveals a 7% annualized loan growth, fueling an expanding 4.24% net interest margin.
Right. They are utilizing a 28% floating rate portfolio to outmaneuver interest rate pressure, and they're deploying that capital heavily into the Houston market.
And they're managing the perceived risk of a 44% commercial real estate concentration by anchoring it in stable, owner-occupied operating businesses.
Furthermore, a management team dedicated to proactive risk control, actively driving non-performing assets down to 1.09% while continuously padding a $34 million reserve vault to ensure 128% coverage of any bad debt.
All of which culminates in returning value through dividends and an 8.8% annualized growth engine for the tangible value of the stock.
It's basically a precise operational blueprint for running a regional financial institution today.
It is. But, as we wrap up this deep dive, the most compelling takeaway might not actually be found in the margin calculations or the Houston loan growth.
No. Where is it then?
It points back to that structural DNA we discussed earlier.
The institutional memory of the organization.
Exactly. Think about it. A bank born in 1908 in the wreckage of a historic panic, a year after the devastating panic of 1907.
Right.
And then choosing to finally take the company public exactly 1 century later, in October 2008, as the modern financial system faced total collapse.
The absolute darkest days of the Great Recession.
Right. So the question to explore is whether that specific origin story inherently, maybe even permanently, alters the corporate architecture of risk.
That is a fascinating way to look at it. Does a financial institution forged in the fires of historic economic crises inherently possess a different, more resilient DNA?
Right. When a management team operates under the legacy of surviving multiple economic apocalypses, it seems to manifest a century later in, 128% reserve coverage ratios and this aversion to speculative real estate.
The data definitely suggests that institutions forged in the fire are structurally built to outlast the smoke.
It's definitely something to mull over the next time you look at where your own money is parked.
Absolutely.
Well, that is all the time we have for today's analysis. Make sure to follow the show for our daily earnings coverage, where we break down the real numbers driving the markets.